My name is Iman SAFIA and I'll be explaining the introduction. So, what is the purpose of this assignment? This assignment aims to analyze the financial position and performance of AME Elite Consortium Berhad using its most recent 2 years of annual report. So, by examining these key financial statements, students can apply financial concepts and analytical thinking skills to a real-world company. This analysis can help evaluate the company's profitability, liquidity, and solvency, while also identifying the trends, growth, and potential concerns. Overall, this assignment enhances students' ability to interpret financial information, making informed decisions, and gain practical insights into how companies operate within the Malaysian financial market. A bit of background about what the company is about. AME Elite Consortium Berhad is a Malaysian-based investment holding company listed on Bursa Malaysia. The company mainly focuses on engineering, construction, and property development, especially industrial properties. Over time, it has expanded from construction into a more diverse business. The company specializes in providing integrated industrial space solutions, including designing and building factories and warehouses. It is well known for developing fully serviced industrial parks. Most of its projects are located in Johor, which is a fast-growing industrial area due to its close proximity to Singapore. These industrial parks are equipped with modern facilities so suitable for manufacturing and logistics. Overall, AME has built a strong reputation for quality development and continue to grow as a competitive player in Malaysia's industrial and property sector. Moving on to the state period covered, we selected 2 financial years from AME Elite Consortium Berhad, which is financial year 2024 and financial year 2025. FY 2024 covers the period from 1st of April 2023 to 31st of March 2024, while financial year 2025 is from April 1st, 2024 to 31st of March 2025. The company used a consistent financial year ending on 31st of March, which makes it easier to compare performance between the 2 years. By using these 2 consecutive years, we are able to analyze changes in the company's financial performance and position, such as revenue, profitability, assets, and liabilities. This can also help to identify any trends whether the company is improving or declining. So overall, this comparison allows for a clearer understanding of the company's financial stability and performance over time and helps stakeholders make better decisions.
AME Elite Consortium Berhad is a Malaysian company that builds and develops industrial parks and large manufacturing facilities. It is known as a provider of integrated industrial space solutions, with its main business being the design and construction of large-scale manufacturing plants and modern industrial parks. The company runs 4 main areas of business: construction, property development, engineering, and property investment and management. To better understand where AME stands today, we can look at its strengths, weaknesses, opportunities, and threats. One of AME's biggest strengths is that it does not rely on just one thing to make money. The company is involved in a wide range of activities, from property development and construction to fire protection systems, renewable energy projects, and even managing workers' dormitories and recreational spaces. This means that even if one part of the business slows down, the other parts can help the company to keep going. AME has also shown strong financial results over the years. The company's earnings per share have been growing at an impressive rate of 41% per year over the last 3 years. On top of that, EBIT margins have grown from 90% to 34% in the last 12 months, and revenues are on an upward trend as well. These numbers show that the company is not just growing, it is also becoming more efficient and profitable. AME's third strength is high insider ownership and responsible leadership. Company insiders own 61% of the business, meaning the people in charge have a lot of their own money in the line. This pushes them to make decisions that are good for the company in the long run. The CEO's total pay for the year ending in March 2025 was also just 81K, well below the industry average of 833K, which shows the leadership is focused on growing the company rather than rewarding themselves. Now we go to weakness. One of their weaknesses is slow stock price growth. Compared to its peers in the same industry, AMI's stock price has not been growing as fast. This makes it less exciting for investors who are looking for quicker returns, and it could affect the company's ability to attract new investment. Second one is below average return on equity. AMI's ROE sits around the industry average of 8.4%, and its net income growth over the 5 years is lower than the industry average of 22% over the same period. This means the company is not making the most out of its shareholders' money compared to faster growing competitors. The third one is a revenue dip in FY 2025. AMI's full year revenue dropped to 716 million in FY 2024, and mainly because its property development segment did not contribute as much. While this may be temporary, it is still a sign that certain parts of the businesses are not performing at full stream. Now we're moving to opportunities. AMI is Malaysia's growing industrial sector. Malaysia's industrial production rose 4.2% year-on-year in mid-2025, driven by stronger manufacturing output, as more local and foreign companies in 2024, and mainly because its property development segment did not contribute as much. While this may be temporary, it is still a sign that certain parts of the businesses are not performing at full stream. Now we're moving to opportunities. AMI is Malaysia's growing industrial sector. Malaysia's industrial production rose 4.2% year-on-year in mid-2025, driven by stronger manufacturing output, as more local and foreign companies look to set up factories and industrial facilities in Malaysia. The demand for what AMI builds and manages is expected to keep increasing. Expansion into Penang and new markets is the next one. AMI is preparing to launch its first industrial park in Penang called Northern Tech Valley, with an estimated gross development value of 1 billion ringgit. This move transforms AMI from Johor-focused developer into a true national player, opening a much bigger market. The last one is entry into the data center industry. In May 2024, AMI sold industrial land in iTech Valley to Digital Hyperspace Malaysia for a record 209 million ringgit, marking its first deal in the data center space. As demand for data centers continues in boom in Malaysia, this could grow into a major new source of revenue for the company. And the last one is threats. First, cyclical property and construction market. Like all property and construction companies, AMI's business slows down when the economy dips. When businesses pull back on spending, they delay building new factories or setting up new operations, which directly hurts AMI's earnings. Second, rising construction costs. Global supply chain issues and inflation have pushed up the price of raw materials, squeezing profit margins for companies like AMI. If material costs remain high, it becomes harder to complete projects profitably. Third one is growing competition and policy risks. As Malaysia becomes a more attractive destination for industrial investment, more developers will likely enter the same space, making it harder for AMI to stand out. At the same time, changes in government policies around foreign investment, building permits, or environmental rules could throw a wrench in AMI's expansion plans. All things considered, AMI Elite Consortium Berhad is a well-run company with a lot going for it. Its strong earnings, growth, diverse business operations, high insider ownership, and responsible leadership all point to a company that is built for the long haul. Its recent moves into Penang and the data center space also show that AMI is not standing still. It is actively looking for new ways to grow. Overall, if AMI continues to expand smartly and manage its risks well, it is in a good position to grow into an even stronger player in Malaysia's industrial property landscape in the years ahead. That's all from me. Thank you.
Assalamualaikum warahmatullahi wabarakatuh to my dear. My name is SHAFIQAH and I will present about the income statement and the statement of financial position. For the income statement, it shows the company revenue, expense and profit. In 2025, the revenue decreased compared to 2024, which indicates lower sales. However, the gross profit increased slightly, showing better cost control. Net profit also decreased slightly, but the company is still profitable. In addition, the earnings per share also decreased, which means lower returns to shareholders. For the statement of financial position, it shows the company's assets, liability, and equity. In 2025, total asset increased, which shows the company is expanding. However, liability also increased, meaning the company has taken on more debt. Equity increased slightly, so the company is still financially stable. Overall, the company is growing but needs to manage debt carefully. Thank you. That's all for me. I will pass to the next presenter.
Now, I will be presenting the financial statement analysis of AME Elite Consortium Berhad for the financial years of 2024 and 2025. So, this analysis focuses on evaluating the company's liquidity, efficiency, leverage, and profitability based on the data extracted from its annual report. Now, firstly, I will be discussing the liquidity position of AME Elite Consortium Berhad. Now, liquidity ratio measures the company's ability to meet its short-term obligation using its current assets. Over here, we can see the current ratio decreased slightly from 2.07 in 2024 to 2.03 in 2025, while the quick ratio declined from 1.13 to 1.08. So, although both ratios shows a minor decrease, they are still well above the minimum benchmark of 1. This indicates that AME continues to have strong short-term financial stability. The slight decline here may be due to an increase in current liabilities such as payables, short-term borrowings, which is consistent with the company's expansion activities. Over here, this analysis, it means that even though the company is expanding and taking on more obligation, it still maintains sufficient liquid resources to cover its debt. And AME's strong liquidity is supported by steady rental income, project cash flows, and industrial property demand, making it financially secure in the short term. Next, I will discuss efficiency ratio. So what is efficiency ratios? It basically measures how well the company uses its asset to generate revenue, right? So the inventory turnover decreased from 1.25 times to 0.99 times. This indicates that the inventory is moving more slowly, but that's normal because they are selling property, right? So for AME, this is not necessarily negative because its inventory mainly consists of industrial properties and development projects, which may naturally take longer to sell and recognize revenue. So this decline is likely due to project completion timing, slower revenue recognition, increase in unsold or ongoing developments. On the other hand, over here is the average collection period. It improved from 73 days to 60 days. So this shows that AME is collecting payments from customers more quickly, which improves cash flow and reduces credit risk. So there is a trade-off. While inventory is slower to convert into sales, cash collection efficiency has improved, which is a positive sign for the company. So this reflects AME's strong customer base, effective credit control, and high demand from industrial clients, especially multinational companies. Now moving on to asset utilization. The non-current asset turnover decreased from 0.89 to 0.65, and the total asset turnover declined from 0.41 to 0.31. So these ratios basically measures how effectively the company uses its assets to generate revenue. So the decline suggests that AME is generating less revenue per unit of assets. However, this is largely due to the significant increase in total assets, which rose to approximately 1.95 billion in 2025. Investment in industrial parks, expansion into new regions like Penang, growth in investment properties and landmark drives the increase. Now, the lower efficiency does not necessarily indicate poor performance, but rather reflects a growth phase where assets are being built up before generating full return. So this is a good sign. AME is investing heavily in long-term projects, so revenue will likely increase in future once these assets are fully utilized. Next, I will be explaining the leverage position of the company. So first of all, the debt ratio increased from 32.32% to 36.23%, and the debt to equity ratio increased from 47.76% to 56.81%. This indicates that AME is using more debt to finance its operations and expansion. At first glance, this may suggest higher financial risk, right? However, we must also consider that the time interest earned ratio, which increased significantly from 29.5 times to 46.28 times. So basically, this shows that the company's earnings are more than sufficient to cover its interest expenses. Although leverage has increased and the risk remains well controlled because the company has strong earnings. Now, although the leverage has increased, the risk remains well controlled because the company has strong earnings. Now, the decrease in debt is strategic because AME is financing new industrial parks, developments, land acquisitions, expansion into new markets. So this aligns with its long-term growth strategy. Last but not least, we will look into discussing the profitability of the company, which shows how efficiently the company generates their profit, right? We can look through their assets and so on and so forth. We'll look into it further. So all profitability ratios improve over here, which is a good sign. Gross profit margin increased from 24.01% to 29.01%. Operating profit margin increased from 22.46% to 24.92%. Net profit margin increased from 17.58% to 20.15%. This is a very positive sign, especially since revenue actually decreased. What does this actually mean? It basically means that AME is controlling costs more efficiently, focusing on higher margin projects, improving operational efficiency. From the annual report, the company's profit remains stable at around 92 million despite lower revenue. So AME is becoming more efficient and profitable even in a challenging environment. Now, this reflects the strength of AME's business model, which includes high-value industrial developments, recurring rental income, integrated services like construction, engineering, property. Now, the return on asset decreased from 5.3% in 2024 to 4.7% in 2025. This ratio measures how efficiently AME uses its total assets to generate profit. Now, the decrease means that although AME's asset base increased, the profit generated from those assets did not increase at the same rate. This is mainly because AME invested more in assets such as industrial properties, land bank, and development projects, but these assets may take time to fully contribute to revenue. So for AME, this is completely understandable because the company is currently in an expansion phase. Therefore, the lower ROA does not necessarily show poor performance, but rather that the company's new assets have yet to produce full returns. Whereas the return on equity decreased from 10.7% in 2024 to 10% in 2025. This ratio measures how much profit the company generates from shareholders' equity. Now, the slight decrease shows that AME generated slightly lower returns for shareholders compared to the previous year. This may be due to the small decrease in net profit and the increase in shareholders' equity. However, the ROE remains reasonable, showing that AME is still able to provide returns to shareholders while continuing to expand its business. This is supported by the company's stable profit and dividend payout.
For the conclusion, overall, the company shows a stable financial performance over 2 years. The company is still profitable and its profit margins have improved, which indicates good cost control. However, the efficiency has decreased because the company is not fully utilizing its asset to generate sales. In addition, the level of debt has increased, which may increase financially risk, but the company is still able to manage its interest payments. Overall, the company is growing but needs to improve its efficiency and control its debt. Okay, for the recommendation, first, the company should improve its asset utilization to increase efficiency. Second, the company should control its debt level to reduce financially risk. And lastly, the company should focus increase revenue through better strategies. Thank you from us.